But Julia, I want to get into the topic for today.
Interesting.
For
Okay.
trivia, path to passive income, part one of dividends. We'll be talking about some stuff next week as well, but some pretty cool stuff to see here. So, how does dividend works? Dividend are basically share of a company's profits given to its shareholders, typically paid quarterly. They can be issued in cash or extra shares, depending on the company. And a company's board is the one that actually decides how our dividends going to be paid and when are they going to be paid, and also the amount. This is where the dividend yield comes in, and this is where you want to see whenever you're looking for a stock that pays dividends. The dividend yield is a per share expressed as a percentage of the stock price. And here is a small example: a 2.5% dividend yield on a $100 stock will be a $2.5 per share annually. So this is the basics of dividend yields. As we said, who decides dividends? Well, they are approved by shareholders, often more often paid in cash than in shares, as shares can actually dilute existing shares, and it's not very preferred by shareholders. Dividend also can be paid either annually, semi-annually, quarterly, or monthly. The schedule will be dependent only on the company's policy, so it might actually vary from company to company, although quarterly is the most common one to see. And the important dividend dates, I think this is very important to have, especially if you're trying to invest in dividends, if you want to know when you're going to get paid. But first, we got the announcement date, when the company announces the dividend and its amount. Second, I think the most important one, it's the ex-dividend date. This is the cutoff date for receiving the next dividend. You must own the stock before this date to receive the dividend. If you own the stock after they announce the ex-dividend date, you will not be eligible to receive the dividend. The record date is the official date the company records eligible shareholders. And fourth, the payment date, the date when dividends are actually distributed to shareholders. So I think the most important one here will be the ex-dividend date to take into mind to actually be eligible to receive the dividend. And this is how it will actually look like. An example, the important dividend date, the declaration date, for example, ex-dividend date, recorded date, and payable date. So also one key is important data of dividends is how do dividends affect stocks? Well, when a company issues a dividend or pays a dividend, the stock price actually drops by the same amount that it's given. This is one of the reasons why it's normally paid quarterly to avoid any big drop on the stock. So that day, the share will actually drop by that amount of the dividend. Although it's more obvious when it's a special dividend. Companies might actually be eligible to announce a special dividend for their shareholders, such as Alibaba did it a few months ago. They actually announced a special dividend, depending on how they actually did on for the quarter, for the year. That's depending on the shareholders. So, for example, if a stock is worth $50 and it pays a $5 special dividend, the price will drop to 45 after the payment. That will happen. It's not very common to see special dividends, but you gotta be on the aware. That's why sometimes having options, you gotta be aware when dividends hit because they can move your stock price. Although they don't tend to move them that much. Then we go to dividend aristocrats. You were asking the other time about dividend, and here we go to dividend aristocrats. Very interesting part. Dividend aristocrats is a company in the S&P 500 that increases its dividend payout every year for at least 25 years. They only have to have two requirements: 25 years plus of consistent dividend increases, and must be part of the S&P 500. Dividend aristocrats may not have rapid stock price growth, but provide consistent income to investors. Basically, they're value stocks. This is one of the cons of dividend aristocrats. One of the three main examples of them: Walmart, ExxonMobil, and also Procter & Gamble.
I mean, yeah, there's on some brokers watch lists, and you can usually find the dividend dates pretty easily.
Yep.
But I think you've actually done a really good job of explaining maybe like some other metrics that might not be commonly available on brokerage platforms themselves that are kind of important to look into, when you're actually trying to get into dividend investing.
True. For people who are interested into getting in dividend investment, who want to maybe at least go with the strong ones, you can actually see dividend aristocrats. There's two ways to track the dividend aristocrats performance. You can look at the S&P Dividend Aristocrat Index, and the S&P High Yield Dividend Aristocrat Index. This is two ways to track them. And they have two pros and two cons. The pros, basically, if you see a company increasing their dividend payout by 25 years, you can take for sure that it's a very strong company with fundamentals, has excess cash for them. So it's a stable income and strong financial for them. The cons, limited growth, as they're investing less money into maybe their research and development on their own growth. Well, they're giving the money away to their shareholders. So that might be signs of a little bit of a more top growth for the company. And also taxable income. Dividends are taxable events and can be reduce the total return depending on the investor's tax bracket. I think that's one of the cons over there in the US.
Right.
Because in Mexico, dividends are actually top at 10% tax. So that's a pro here.
Yep. And then also Theta Trader brings up an interesting point to kind of like keep in mind if you do actually get into dividend investing, which is that suppose that you have like a high dividend ETF that tracks the S&P 500 is going to perform a little bit worse than the S&P 500 over time because it is paying out funds in dividends. So while it is meant to sort of track not one for one, but it's supposed to track sort of the performance of the S&P or the performance of Bitcoin or the performance of whatever underlying it's meant to track, right? It might not perform as strongly because it is paying out in dividends. But that being said, that's a different source of investment income. And depending on, your directional bias or preferences around a particular underlying, it might be better to choose like a higher dividend paying version of it because, for the reasons that we talked about, might be a little bit more not fixed, but the expectations might be a little bit more reliable, if that makes sense.
For sure. But it's a way to get a stable income maybe with dividends. Warren Buffett alone receives every quarter by Coca-Cola around $200 million in dividend alone from Apple as well, just on dividends. So obviously we're talking about big leagues here, but it's a good way to receive some extra money, plus entering some stocks that are less prone to more market volatility, as well as they're more stable and have been more stable. So they are value stocks.
And then you also, just to kind of go back for a second, but you also mentioned like how dividends might impact the price of a stock, which is going to impact the options and how they perform. But in addition to that, there's something called dividend risk, which can also affect options. But basically, if like you have short calls on an underlying that's about to have a dividend date, basically, if your calls are in the money, your chance of assignment's a bit higher than it would be if there was not a dividend date. So you need to be mindful kind of that. It can affect options in that way as well. If the calls are out of the money, then it's much lower risk of getting assigned, right? But that's still a risk that you need to kind of keep in mind. And again, the policies kind of depend on the specific broker and how they kind of handle that. But that's another impact that it can have on the options too.
Yes, for sure. So it's always key whenever you're trading options as well to take into account dividends. Sometimes I think, especially when I started, I think I always forgot about looking to dividends. Now it's always important to also look at them. And now you also have, Julia, besides dividend aristocrats, dividend kings. Dividend kings are companies that have increased their dividends for 50 years plus, even longer than aristocrats, so double them. The only key difference is that they don't have to belong to the S&P 500, although you might not see a company, a dividend king, that it's not part of the S&P. I did not knew about dividend kings. So for people who are actually want to go into more secure, maybe investments on dividends, more stable companies, two great examples of companies are looking to dividend kings.
Nice.
And for the ETFs, there are also two types of dividends for ETFs. As you and I entered Vito, we might actually take this into account because they have to do with the taxable, how they are taxed. First one is the qualified dividends. They are taxed at lower capital gain tax rates, 0%, 15%, or 20%, depending on income, if the ETF declares them as qualified. To qualify, you need to hold shares for more than 60 days. That's one of the requisites. And the non-qualified is basically you need to pay ordinary income, will be as high as 37%. And it's applied for people who own the ETF for less than 60 days. For example, SPY ETF has both qualified dividends and non-qualified dividends. So
interesting.
Depending on how much time you actually hold them, it's also how much you're taxed on the dividends. Basically, as for long-term and short-term investment, if you hold a stock more than a year, different taxable than if you hold it less than a year.
Nice.
And for next stream, Julia, I want to talk into some other stuff about dividends. Part two, dividend policies, dividend safety scores, some of the metrics that are actually useful for people who are looking to add dividend stocks to their or ETFs to the portfolio, dividend yield versus dividend growth, dividend reinvestment plans, and also the impact of interest rates on dividends, as right now we're entering an easing cycle for the Fed.
That's awesome. Thanks for putting all this together. I found it really interesting.